Okay, we are streaming. So let me mic you up.
Okay.
All right. Just go a little closer. And you're live. You're good.
What is it?
You're live.
Hello. Good morning, everybody. As most of you know, I'm Frank Kapitza, and I just wanted to discuss briefly with you different topics related to taxation. The first topic is an entity structure. So you start your own business. What do? What do you call yourself? Your choices are a Schedule C, an LLC, an S-Corp, a partnership, or a C corporation. So which choice is best? You already know the answer to this. It depends. Let's just say somebody has just a small little business and they don't even know if it's going to succeed or not, and they're just testing the waters. To do the right thing as a CPA is to tell them just to file it on a Schedule C. Don't even set up an LLC. Just file it under your own Social Security number and see if it works. If it does work, then invest $125 with the state of New Jersey and get an LLC formation. And some of my time to set it up for you. Then you have different forms also. You can graduate from an LLC, and what you could do is you can make an S election. An S election is very profound. You're not changing the entity structure when you're making an S election. What you're doing is you're electing to be taxed as a corporation, that's an S corporation, when you actually remain an LLC under state law. Why would you do that? The number one reason is to save on the self-employment tax. The self-employment tax is a nasty tax that self-employed people have to pay. And here's how it consists. When you have your own paycheck, you got deductions that are 6.2% for FICA and 1.45% for Medicare, which is 7.65%. And then when you're your own business, you get to double it, and that equals 15.3%. It's a nasty tax because a lot of times the self-employment tax is higher than your entire income tax, depending on the situation. So here's how you could save that. You could set yourself up with an S election on your business and put yourself on payroll. Just as an example, if your business makes $120,000 of income and you put yourself on a salary for $40,000, you're only going to pay self-employment taxes on $40,000 at 15%, which is $6,000. You're going to save the self-employment tax on the reciprocal $80,000 times 15%, and that's $12,000 of savings in the self-employment tax. So it's going to be a self-employment tax of $6,000 versus a self-employment tax of $18,000, a $12,000 savings. Now, the next obvious question is, why doesn't everybody do this? Does it make sense 100% of the times? The answer is no. You have to do a full discovery of the client. Let's just say, for example, the client is very young, in their 30s. Then it most likely makes sense, because saving the self-employment taxes now can be a huge benefit versus a benefit down the road. Because there are two disadvantages of making an S corporation election. First, you get less brownie points to the Social Security Administration. Like in the previous example I said, you're going to get Social Security earnings of $40,000 versus Social Security earnings of $120,000. That means you're going to be getting less Social Security, presumably, when you turn 67 or 70, or 62, depending on when you retire. So if you're very young, most of the times the answer is make the S election, because you don't want to wait 30 years for a future benefit for a future Congress. But here's an example, okay, where it won't make sense. Let's just say you're 55 years old and you're working for cash all your life and you don't have any Social Security earnings to speak of. Here's a situation where you want to retire and you want to get Social Security and be eligible for Medicare. I just turned 65 years old 2 months ago, and Medicare is very important. To make a long story short, my medical insurance bill went from $1,241 a month down to $404 a month, and that's with the supplement, and $800 savings. So, for example, if you're 55 years old and you don't have any Social Security earnings to speak of, then you don't want to make the S election. You want to pay the self-employment tax so that you can get Social Security income and be covered for Medicare going forward. So again, my whole point is this. As a CPA, you've got to do a complete discovery of a client when they arrive, because it's different strokes for different folks. Not everything works for everybody. And that's why you have all the options that you do. Another form of entity selection is the partnership. With the partnership, you have to be very careful, because you were always taught as a kid to be responsible for your own mistakes. And now with a partnership, you're also responsible for the mistakes of others. So you have to be very, very careful about who you pick as a partner. The last entity selection is the C corporation. The C corporation is very profound. It has a flat tax right now of 21%. Is it a good thing? It depends. Again, if you're basically going to, the C corporation, the fallacy with the C corporation is subject to double taxation. But you can eliminate the double taxation by one full swoop, and that is just by giving yourself a bonus at the end of the year through payroll. That could wipe out the earnings, okay, of a C corporation, and hence you're only paying taxes one time. Or you could basically just have your own salary in the C corporation and have the residual profit tax at 21%, and then reinvest that 21% back into the business. There it makes sense to be a C corporation, whereby you're going to be paying less tax, 21% versus 37%. And that 21%, that 16% savings can be reinvested back into the business, thereby saving you 16% of your tax. What's ideal, if a taxpayer has two businesses, to make one business an S-Corp and one business a C-Corp. Because there you got the strategies of one business is for your income and one business is for your expansion. So the long and short of this whole thing is this. You have to do a complete discovery when you meet a client, because nothing works best every single time. All right. The next thing I want to talk about is common deductions that people miss. And usually the number one thing is auto, because people don't keep the right logs. They don't use a business card every single time to put gas in their car. They don't use a business card to get repairs. And you have two choices, the actual or the standard mileage rate at 72.5 cents a mile. What is better? Again, it depends. You just have to do a complete discovery and find out what rate is better. And the same thing with leasing a car versus buying a car. Now, okay, you have special bonus depreciation, and you have lease expense, okay, that's pretty much entirely deductible at 100%. So you have to crunch the numbers and just ask very good questions. You know, there's a computer term called GIGO, which stands for garbage in, garbage out. You have to ask the right questions to the clients to get the right answers, to give them the right advice. It's that simple. Then other things that you can do is you can do retirement plans. Retirement plans are an excellent vehicle to save money on tax. And you're going to accomplish two objectives. You're going to save money for your retirement, and you're going to save money in tax. Retirement plans, here's what you have to be careful of. Too much or too little. Let's just take too much. If you take too much, then it's going to curtail your income and your spending, because you still have to pay your mortgage, you have to pay your car insurance, and all these other bills. If you put too much into a retirement plan, it could present a problem. You have to put enough into your retirement plan where you don't touch it ever until you retire. You have to have tunnel vision with it. That's the best way to go. So sometimes it's almost like if you go to the gym. You have to do something that's sustainable. You'd rather basically cut your workout in half and keep doing it consistently than to make your workout very difficult and then give up. And that's what I've seen with retirement plans. That some people fund their retirement plans so aggressively that after a while, they just get tired of it and they can't afford it, and they go from 100% to a huge amount, the maximum that they can deduct, to zero, where they would have been better off doing 50% the entire time, because that's sustainable. So, what else, okay? On the big, beautiful tax bill, okay? We have 100% bonus depreciation. This is really profound. That you can take something that costs $100,000 and depreciate the whole thing in one shot. Think about how this thing works. You can buy something in December of 2026. File your tax return in January of 2027 and get a tax benefit of, let's say, $40,000. It's just 100,000 times, 40%. And save 40 grand. And meanwhile, the lease payment costs you $2,000 in December and $2,000 in January. So think about this. You paid $4,000 for this piece of equipment, and you're getting a tax benefit in cash of $40,000. So you're buying an asset, and you're getting money in your pocket as opposed to putting money out of your pocket. And by the way, that's one of the reasons what makes this country so successful. If I wasn't an accountant, I'd be an economist. Because back in other third world countries, there is no financing like this. There's no tax laws like this. And people are forced to pay out money in full for something, and that delays economic activity. So think about this. On one hand, you're living in a country where you have to save up $100,000 to buy an asset. And unless you have $100,000, you don't have that asset. And unless you have that asset, you don't run your business. In this country, you could put out $4,000 and get back $40,000 and have your asset now and run your business now and make money now. And I think that's really profound. Real estate and depreciation strategies. A lot of people basically buy a condominium, shore house, or anything like this. There are enormous opportunities there for you. One is the Augusta rule, which lets you basically rent out your place for 14 days, tax-free. You don't have to report the income. That's a very good benefit. Then you can also do something called cost segregation, where you can take the real estate and break it up into individual components. And the individual components means that you can depreciate something faster. And if you can depreciate something faster, that means you're going to get your tax benefit sooner. It all works on the present value of money. And even depreciation itself. Think about how this works in real estate. On the books, you're taking your real estate down in value. But in reality, it's going up in value. And that's an enormous benefit for having real estate. By bringing it down on paper where you get a tax benefit, And it's also a non-cash benefit, where when you deduct depreciation expense, it doesn't cost you any money. And in reality, it's going up 2, 3, 4% per year. And your rents are going up. So what happens with real estate is usually the first or second year when you buy something, you put down 20% of the years that are tough. You may have a small negative cash flow. But then years 3, 4, 5, 6, 7, it's great. Because what ends up happening, you're going to end up charging 2 or 3% more rent every single year, where most of your expenses, except for maybe real estate taxes and what have you, are going to be fixed for the most part. So your cash flow is going to keep going higher and higher. And not only that, your equity is going to keep going higher and higher. Then what you can do is when your equity increases, you can actually take your real estate and buy some other real estate by doing a 1031 exchange, whereby you can transfer the real estate and not pay taxes on the appreciation and get even a larger piece of real estate. The advantages of basically proper tax planning. This is what it comes down to. People don't fail to plan. People don't fail to plan. People don't plan to fail. They fail to plan. And if you plan accordingly, you can avoid huge tax mistakes. For example, if you need money, borrow the money. Don't take it out of your retirement account, especially if you're under 55 years old, because you're going to pay a hefty tax that's going to go on top of your other income and a 10% penalty. And by the time it's all said and done, you're only going to net about half of what you took out. So if you took out $100,000, you'll only net like maybe $52,000 when you pay taxes. What you could have done more easily is just borrow from the equity of your home and then pay that off. And the interest that you're paying on your home is also going to be tax deductible. So with that, let me ask you this. Let me just open up this to the audience and ask, does anybody have any questions so far? I mean, I went somewhat quickly on this, and I apologize if I went too fast, but anybody have any questions on what I talked about just so far? What I can do for you all is basically, I'm going to be available even today, over the weekend, and next week. If you have any questions on this, especially on the entity structure, that's probably the most important one. Because if you mess this up, you messed up from the onset, and it's a real pain in the neck to basically go there and recreate something and do something differently. That's why it's really important, to pick the right entity from the onset. So if you know anybody that has their own business or starting their own business, have them see me. Because the choice you make at the beginning is very, very important. While anything can be reversed, well, nothing is fatal. It's going to be a real pain in the neck to basically change something when you could have done something initially so much easier. Make sense? And then, what we do here is we just basically show you how to keep proper expenses and maximize hybrid expenses, like your car, meals, things like this. Even buying a camera, you can basically say part of it is for business. You always have to look for anything that you can to reduce income and reduce tax. So with that, I wish you all a happy weekend. And if anybody has any questions, feel free to give me a call. I'm always available for you all.